This is a download from BFM 89.9, the business station.
Good morning, George. U.S. stocks have been on a tear lately. Even as the market closed overnight, the Dow hit a record high for the sixth day in a row. So what's going on, George? I mean, what's fueling these highs?
Well, good morning, Melissa. We have the fact that low interest rates continue, although we're now beginning to see positive signs in terms of economic growth or strength, and the low interest rates environment still continues. So we have a really Goldilocks economy, a Goldilocks view of interest rates at this point. It's not going to continue. If you go back in February, the markets were shaping up to have a turn in the bull market that we were experiencing into a transition to a much more of a bear market. But since then, the markets have gone to new highs. It's disrupted the natural trend of the market. So we expect this to continue for some time. Those who have anticipated the turn into a bear market have paid the price dearly. It does not pay to anticipate. One might as well enjoy the continued upswing. We're seeing some relatively positive comparisons in terms of earnings growth and also of the projections on future growth of revenues. That is continuing to have some support for the market. So for now, we continue to see the markets looking to the upside as opposed to looking down.
But enjoying the upswing, Dodge, it's all about a matter of timing, right? So what will you be watching as a gauge of when to get out of this?
We watch very closely buying power and selling pressure. We look at stocks. We look at the volume that is created each day, and we see if the stock has moved up or down, and that will determine the strength of the move to the upside. We watch the technical analysis where there is support. Support is, for example, the average of a stock price where longer-term investors who've been in the stock for more than 200 days, the average price that they have bought, that tends to be fairly substantial support, particularly in the market as we are now, Melissa. Once that breaks, then we look for how far the stock will go down and whether there is a move back to try to return to the prior highs. That's where we are now. Until we see a more significant move to the downside, we are staying away from the short side of the market. We are buying pullbacks, and that tends to be the way the market's reacting right now, particularly on those that are interest rate sensitive. We're still seeing some interest in high-yielding stocks, real estate investment trusts, which have to take 90% of their cash and distribute it to shareholders. Those tend to have continued strength. Now we're beginning to see more strength in financials and other sectors that are not as interest rate related.
Well, the earnings season in the U.S. is in full swing now. Dodge, how have you digested some of the results? And in your view, watching the way the market has reacted to earnings announcements this time around, has there been anything different to that?
Yes, we see, first of all, we see a much greater reliance on earnings or less reliance on earnings and a much greater reliance on revenues, both in terms of the actual revenues now and the projected revenues for the next 2 quarters. Also, absolute versus relative. If you take a look at Goldman Sachs, for example, the absolute performance, the absolute earnings were good. They were very positive, but a lot of that had already been factored into the market before the earnings announcement, and so Goldman Sachs has not acted as strongly as we expected. On the other hand, you have something like an ISRG, Intuitive Surgical, a much smaller stock. The revenues were $670 million versus $640 million. Their worldwide procedure growth was up 16% versus projected being up 13%. The growth in general surgery, everything was quite positive. And so tonight you saw the market bid the stock up from 670 up to 725. It ended at 716. That's a pretty tremendous growth, and that was because the results in the revenues were not expected. Microsoft also was very, very good. But again, the expectations versus what happens and what has already been factored into the market are affecting it. So what we're watching for Microsoft to continue its uptrend. its uptrend. We expect it to continue. It closed at $53. It's now at $55.30. We expect to see some continuation tomorrow. We are really watching for the three moves once earnings are announced. The first move is the immediate reaction within the first 15 minutes. Then there's a reaction, a pullback, or a further move to the upside. It's the third reaction, what the market makers are beginning to see after the first half hour of news, particularly, Melissa, when the earnings are announced either before the market opens or after the market closes. That tends to determine the continued move of the stock once our markets are open, and we're seeing that to be fairly consistent now. There are some fairly large surprises. Most of the stocks that are opening are not behaving in what was expected based on what you saw in terms of the performance before the earnings announcements. And again, all of this points to the fact that there is not as much confidence in the longer-term future of the stocks versus the shorter-term moves, and there really has been a difference between the company and the price of the company's stock.
Dodge, just going back to what you said earlier about some of the things driving the record highs in the stock market, you talked about the lower interest rate environment. So the consensus of the market is that there will be a lower interest rate environment for longer. But what about the perception of the non-continuation of low interest rates? What impact will that have on markets?
Exactly. What you're saying is absolutely true. There has been no change in the perception that low interest rates are going to continue for some time, particularly away from the United States, but even in the United States now. So what the market is watching is the economic performance of our market and our economy, and whether it's strong enough to give enough confidence to allow interest rates to return to more normal levels. In other words, to continue what the Federal Reserve had tried to start but has had to stop. The perception is that it's not happening yet, and so therefore the low interest rates will continue. But now we're beginning to see the fact that the economy is behaving, particularly in homes and the growth of home purchases. We're beginning to see much more confidence. That is going to shorten the time frame that one expects low interest rates to continue.
Okay, so to keep an eye on economic performance. No doubt politics will throw a spanner in the works, Dodge. The Republican National Convention is going on at the moment. What do you see as the impact of the upcoming presidential elections on markets?
Disruption. In other areas other than politics, disruptors and disruption has proven really good for the consumer and for the economy as a whole. But within politics, disruption now, the markets do not like uncertainty, and we're entering the June through September period where we have the conventions, we have the after the conventions, we have two candidates that are not particularly valued as being positive, and it's just right now the decision has been more the lesser of the two negatives. We expect that to continue for some time, but after we get through the two conventions, then we expect the solidification of interest in the two parties. And at that point, I think the market will be able to be more certain about the political outcome. Until then, it's going to be an up and down affair from week to week. This week is the Republican convention. We're seeing a lot of disruption even on the floor of the Republican convention. That is not necessarily negative for the U.S. as a country, but in terms of politics, in terms of what it does for the market, it does disrupt the market, and it creates the uncertainty that will continue the volatility that we've been seeing, Melissa.
Dodge, thanks so much for your time. That was Dodge Dorland, Chief Investment Officer of Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.